G'day everyone, my name is Ishkanian and I'm an investment advisor for Adrian Day Asset Management. Please join me in this interview with Adrian Day, the Chairman and Chief Executive Officer of Adrian Day Asset Management. Please take a moment to view our disclosure page. Well, g'day everybody and welcome to Adrian Day Asset Management. I'm here with the famous Adrian Day. So Adrian, I understand you went to the famous London School of Economics. Can you tell us about that?
Yeah, that was a great experience. I mean, the LSE is obviously a well-known school for economics and social studies and so on. A lot of finance ministers and central bankers from around the world graduated from the London School of Economics. Mick Jagger also attended. He didn't graduate, though.
So I see that's why you favored them over the Beatles all your life, right?
I have one up on Mick. But it was a great school, it really was. I mean, it wasn't great. We didn't have much of a sports program, and it wasn't much of a social school. But for academics and for politics, it was fabulous. We had some great professors over time. It's a left-wing school. I mean, it was founded by socialists back in the 1920s, but they always had more conservative as well as Austrian economists at different times, Lionel Robbins, Frederick Hayek, Peter Bauer, all taught there. Okay.
And obviously you're well known in this space for being the money manager in America with an English accent. When did you leave the UK and what prompted you to leave?
That was 1974 I left, and I actually came over here. I came to the Bahamas originally to work on something called the New Country Project. We don't need to go into that now. But I never sort of woke up one day and said, I'm going to emigrate to America. I came over here for this project, and, you know, one thing led to another, and here I am.
Right. Okay. Well, that makes sense. Of course, we're recording this here in Puerto Rico, so not too far away from the Bahamas. So how did you get into money management?
I was in the 1970s and early 80s, I was writing on economics. So I was editor of something called Personal Finance, Inflation Survival Letter, Personal Finance, a big investment newsletter. So I was writing on it. And frankly, I had so many people just say to me, hey, can you manage my money? I don't have time for this. Can you manage my money? I don't have time for this. And that's really how it started. I saw people who, you know, made horrible mistakes. Turning a winner into a loser is one of the worst things you can do in investments. It's one thing if you invest in something that never goes up, but to sort of lose money on a winner. And I saw people make fundamental basic mistakes. And so I thought, it'd be a good idea if I just started managing money for them.
Okay.
And I did that in 1991.
And that's when you started Adrian Day Asset Management?
Correct.
Okay.
Correct.
And what would you say is your management style? I understand that you're attracted to value investing. Would you say that you're a value investor?
Yeah, definitely. We have four basic tenets. One is value, one is global, one is long-term, and I think the fourth one is quality. So I'm not the type of person that likes to buy some pig that I think might double in the next 24 hours. That's just not what I do. So value is definitely important, and all value really means is buying something that is trading at a lower price than its intrinsic value. Now you have to work out what's intrinsic value. You have to work out whether you think avoid value traps. Is this something that's just going to continue to go down? I'm sure horse buggy whips in 1880 were probably pretty attractively priced. But basically, that's all value means, buying something for selling for less than its intrinsic value.
Okay. And you're well known for investing internationally. Why should investors consider investing internationally? Is there something special about the foreign markets? What is it that brings you there?
I look on myself as a global manager. International, I mean, technically, international means non-U.S. and global means everything, including the U.S. And it's different. It has changed an awful lot. But when I first came to the U.S. in the early 70s, not a lot of managers would invest internationally. John Templeton obviously had a lot of money in global markets, but most brokers, most investors didn't. Warren Buffett, used to famously say, "There's enough opportunities in the U.S. Why look outside?" I mean, to me, if you restrict yourself, whether you restrict yourself to the United States or restrict yourself to the eastern United States or the southeastern United States, you're just artificially cutting off an awful lot of the opportunities out there. And so different markets at different times perform better. The last 15 years has been an incredible time for the U.S. market, but it hasn't always been that way. There have been times in the past when the U.S. has been a decided underperformer. And I mentioned John Templeton. You look at Templeton, he had the global fund, but at different times he had over 80% of his assets in the U.S., and at different times over 80% of his assets in a single market like Japan. So being a global manager just means you're prepared to look for opportunities everywhere. And sometimes there's just better opportunities in other markets.
Okay. And obviously the style right now in the United States is to go for growth and momentum. How important would you say that dividends are for investors at the moment?
I think dividends are very important even for people who don't need the income. My friend Doug Casey likes to say rather irreverently that dividends are an outward sign of inward grace. And what that basically means is that if a company can consistently pay a dividend, and hopefully a rising dividend, that company's clearly doing something properly. It's doing something well. And so you may not need the income, even if you're young. Looking at dividends means that you're buying good qualities, first of all. Secondly, we shouldn't forget the eighth wonder of the world, which is compounding. So if you're young and buy dividend-paying stocks, that money compounds over time, over decades, tremendously.
Okay, that makes sense. And you're well known for speaking at mining conferences and at other investment conferences. What originally attracted you towards the mining space?
Yeah. I think I was just, I was always interested in economic history. And so I was interested in the gold standard because that's part of 19th century economic history. And I think it was a natural progression from being interested in economics to being interested in economic history to being interested in the gold standard to being interested in gold. My very first investment when I was a boy in short pants, I went into Sphinx in the Aldwych, and I think they looked at me a little askance, but, I got my money from my piggy bank out and bought a Gold Britannia. That was my very first investment. And so when you're investing in gold, I think that the transition to mining companies is just a natural progression because, of course, they obviously have a lot more leverage than just gold itself.
Can you explain how that leverage works with mining companies? So if someone's bullish on gold, silver, copper, how do they make more money in a rising price environment in a mining stock?
Yeah, I mean, basically, it's quite simple. Basically, if the price of a commodity, in this case gold, if the price of a commodity is rising faster than the costs of mining it, then you have tremendous leverage. If you think that the price of gold, let's say the price of gold is $1,000 and your cost of mining is $900, you've got a 10% margin. But if the price of gold doubles to 2,000 and the costs go up to 1,000, well, suddenly your profit margin has gone up tenfold. And so the margin, the leverage you see in all things, and it's not just in the production, but you think of reserves. So if a company has 20 million ounces of reserves and the price of gold doubles, your reserve, the value of your reserves actually goes up more than 100%. Because as the price of gold moves up, you can bring more ounces into your reserves. So not only does the value of your existing reserves go up, but you bring more ounces into reserves. Similarly, if you have a mine and the price of gold goes up, you can justify building an expansion to that mine. You can justify doing brownfields exploration and expansion. So your leverage is the increase in the value of your mine is much more than just the increase in the price of gold. And of course, as cash flow, I just mentioned with the simple example, I mean, the cash flow goes up far more than the price of gold goes up.
I see. And I know you're a big fan of the royalty and streaming business. I don't want to get into what the distinctions are here, but how did you first come across that model, and why are you such a big fan of it?
Yeah, this goes back to 1985 when I first invested in Franco-Nevada. I first met Pierre Lassonde and Seymour Schulich, the two founders of Franco-Nevada. I had known Pierre before that, actually. Pierre had helped me quite a bit, even in the years before that, but I got introduced to Franco-Nevada when they started that. I went on a mining trip, and the irony, I guess, is standing on a hill, Hasbrook Hill, and this was going to be the future of the company. And then they got into the royalty business, which is a tremendous model, because the royalty streaming, we'll just call them royalties for now, is basically like an investment bank. So a royalty company will lend money, or give money in this case, to an exploration company, a development company, a mining company, whether it's for exploration or development or expansion, or sometimes, frankly, just to improve a balance sheet. They will get money in exchange for a piece of the production. So again, let's keep it simple. You might have a 2% net smelter. That means that the royalty company gets 2% off the top of whatever is produced, which means they don't have to worry about the costs. They don't have to worry about the pitfall collapsing. They don't have to worry about the environmental protests or the government of the local country, increasing royalties or taxes on the mining company. The royalty company has a contract to receive X, whatever it is, 2% off the top. So long as that mine's in production, they get that revenue. So you can see from that as a business model, it is far lower risk than a mining company. Mining, Robert Friedland likes to say, in mining, Murphy works overtime. Anything that could possibly go wrong will go wrong, and many things that you couldn't imagine would go wrong will also go wrong. The mining company doesn't have to worry about that.
The royalty.
The royalty company, the royalty company. And so just as the business model is a lot lower risk, then so too are the stocks. The royalty companies are the lowest risk gold stocks out there.
Right. Now, I know you're well known and well regarded for managing the more risky side as well with the juniors. I mean, most managers, they have difficulty looking at juniors because there's no earnings per share that they can analyze. They don't understand the ore body. They can't look at a drill result and see if, is 2 grams per ton a good result at the moment. How did you get into looking at juniors as an investor and for managing other people's money?
Yeah, well, obviously the juniors are much more exciting. They're more exciting to write about. They're more exciting to invest in. But to me, it was a little bit of a barbell approach, if you like, having physical gold and having royalty companies. Royalty companies, to me, are the best stocks to have as a foundation to your mining portfolio because they are so low risk.
On a relative basis, right?
On a relative basis. Well, they're low risk. They might still have volatility, but they're low risk. And that's one of my pet peeves, people who confuse volatility with risk.
Fair enough.
Two different things. But to answer your question on the exploration, I'm not a geologist. And I don't have any edge. Obviously, I've picked up a few things over the years, but I don't have a real edge over genuine geologists. But I think I'm good at analyzing balance sheets, and I'm good at looking at business plans, and I'm pretty good at assessing people. And to me, the people is that's the most important factor in a junior company. I will much rather have a management team with a lousy project and no money over a bad management team with a great project and lots of money, because the second one, they'll just waste some money and destroy the value in the project. And so people are the most important thing. But getting to know people means getting out of the office. You're not just spending 4 or 5 hours analyzing reports as they come in. You've got to get out of the office. You've got to spend time with people. I mean, obviously, being around for so long, I know all of the CEOs of all of the mining companies. But when it comes to the juniors, I like to really spend a lot of time with those people. I like to, not just in the office, but I like to go to dinner with them, see how they interact. I like to go on mining trips with them, and that's critical how do they treat the local people, and how do the local people in return regard them. You can tell an awful lot of whether a company is going to be successful or not by seeing an animal in his native habitat, as it were. And so I understand that takes a lot of time. And for a lot of even good investors, for a lot of very good investors who analyze balance sheets very, very well, that's just not a skill set that they have or something they want to devote time to.
That makes sense. I know Peter Schiff hired you to run the Euro Pacific Gold Fund. How did you first meet Peter?
Oh in first meet Peter. That's been probably 30 years, I would think, and I mean, we're both in the same business. So I mean, I came across him at conferences, saw him on TV, bumped into him here and there. I also remember his dad, Erwin Schiff, was a speaker at one of the conferences I was at. But it was 2013 or 12 that he approached me about managing the gold fund that he managed. And obviously we've worked closely since then.
Okay. Now I understand at Adrian Day Asset Management, you offer managed accounts?
Yeah, the separately managed accounts.
Right. Can you tell us a little bit about how that works and what you offer?
Yeah. Well, we tend to be a lot more flexible, I think, than a lot of money managers, and a lot of, certainly than funds, and other, investment advisors. So our accounts are all personalized. They don't have to be, but they can be personalized. So at the most basic level, a person who doesn't want tobacco stocks and does want tax loss selling, at the basic level. But sometimes people's wishes and desires are a little more nuanced than that. And sometimes, frankly, they don't even know how to express it. So with our clients, we know them well. We know if a client can tolerate volatility or can't tolerate volatility. We know that. If you ask people, everybody says, I can accept volatility, don't worry about it. But in practice, some people can and some people can't. So most managers will manage to a model, which means that every client, you open an account on this day and you immediately are positioned exactly the same as everyone else. Now, I'm not saying there's anything wrong with that. I mean, the big benefit of that sort of style, of course, is that everybody gets the same performance. But we don't manage to a model, so our accounts tend to be much more flexible. So we have people who say to us, for example, I'm a conservative investor. I want a conservative global account with lots of dividends and income. But hey, I really like gold. Give me a little more gold than you give someone else. And, we can do that, whereas a lot of managers I know have difficulty with that. We also have lower minimums than other people. I don't get head up on minimums. I like to say that if it makes sense to the client, within reason, of course. If it makes sense to the client, we will accept that account. Now, a lot of clients, a lot of money managers will have $1 million minimum or even higher. But we've had accounts as low as 25,000, for example, where it makes sense.
Okay. And I imagine if it's appropriate for the client and they say to you, Adrian, I want to have more juniors or I want to have more silver mining exposure, is that something you can accommodate in a separate account?
No, absolutely. If they ask us for something that's more, let's say, more risky or more volatile, like they want it only in juniors, or this is all of the money they have, obviously we lay it on heavy with, we make sure they understand the risk.
Okay.
But I've always said it's the person's money. If the person wants 50% of his money in gold stocks, that's his business, so long as he understands the risk. But whether you can accept the risk and the volatility, again, two different things, is not just a matter of financial circumstances. Do you have the assets? Do you have the savings? What are your future obligations, for example? A person that has 3 kids who are about to enter university, you don't really want them gambling everything on junior gold mining stocks. But equally, I mean, we had a lady come to us once. She was 92 years old, and she wanted all of her money in junior gold stocks. Don't buy me Barrick or Newmont. I can do that myself. I want you to buy. And my assistant called me and said, listen, I think you better talk to this lady because this is what she wants. But when you talk to the lady, that's exactly what she wanted. She knew what she wanted. She was very intelligent. She said, when I pass, I have no heirs. All of my money's going to the cat house. Not cat house is the wrong word, sorry. Is going to the, animal farm.
Right.
And so I just enjoy doing it. So I want you to put it all in juniors. And for a person like that makes absolute sense. But the point I was making is, you can have a financial acceptance of risk and volatility, but you also have to have the mental acceptance. And there are some people, I know them, we have clients, who are extremely well off. But if their account goes down 5% in a month, they start freaking out. And so you have to know yourself, the client has to know himself, and we have to know our clients.
Okay, I see where you're coming from on that. I mean, everyone has a different stomach when it comes to the swings. I also wanted to ask you, I mean, we've spoken about gold and precious metals. Obviously, you anticipate potentially the US dollar falling from this point. Why would that set off a general commodity bull market? I mean, if America has inflation and maybe goes into recession, why would copper and oil go up?
Well, first of all, of course, most of these commodities are priced in priced in dollars. Sorry, let me say that again. Most of these commodities are priced in dollars. So everything else being equal, if the dollar goes down, the price of a commodity goes up. But as the dollar goes down, it can often work to the benefit of other countries. And it makes their currency stronger, which means they can afford to buy more things. And if they buy more things, those things take commodities to build. Whether it's Indonesian middle class buying refrigerators and automobiles, all those things take commodities. So when the dollar goes down, it's typically positive for commodities.
Okay. Obviously, we're not expecting this bull market to come to a close anytime soon, but what would you say are some indicators that one might look out for to know that, hey, maybe this isn't the right time to maintain my gold mining position or precious metals holdings?
Well, I do agree with you, Mark. I think we're a long way from that at the moment. I think it's important that people realize gold cycles and commodity cycles typically are much longer cycles than a typical economic cycle, which might be 4 to 6 years, but a commodity cycle can be a lot longer than that. And they don't necessarily correspond with economic cycles. With gold in particular, it's difficult because it's difficult to value gold. How do you value gold? It famously doesn't have earnings or pay a dividend, as the detractors keep telling us.
They keep saying it's a pet rock, but really it's a metal, right?
And so, but how do you value something that doesn't have dividends or earnings? Like if you're valuing Nestle, you can look at their dividend, you can look at the dividend compared with other food companies, compared with Nestle's own historic dividend yield. And you can say, well, right now it would appear at a 4% dividend as opposed to a historic 2.2% dividend yield is probably inexpensive. Oh, the price earnings is lower as well. You can't do that with gold. And so to a large extent, when you're looking at gold, you're valuing gold relative to something else. You're looking at gold relative to the amount of debt in the world or the amount of money in the world, or you're looking at gold relative to financial assets. There's a famous chart that people have probably seen of gold versus the Dow over the last 100 years. And you can see how it moves in these long waves, and sometimes gold is overvalued. And you could see that clearly on this graph in 1980. If that's all you looked at, you would say, maybe we're getting close to a top here, and stocks close to a low. But most of the signs you have to look for are sentiment and anecdotal. Is gold a popular asset? Is it something people talk about? When you turn on CNBC, is gold the first thing they talk about, and are they all bullish on it? We were watching CNBC this afternoon, and they were talking about NVIDIA and AI. So but go back to 1980, and gold was on the front page of Wall Street Journal. So that's the thing. It just anecdotally, is it a popular asset? When you go to a dinner party, do people talk about gold? You know, in the way that in 2007, everybody sat around talking about the latest house they just bought and flipped. All of these things are signs of a top, but we are so far from that right now. It's worth paying attention to, but we're not anywhere close. And the gold stocks, in my view, are just still remarkably undervalued because of what we were talking about earlier. The leverage, as the price of gold has gone from 2,000 to 44 or whatever over the last 18 months, but the cash flows have gone up much more than 100%.
Okay, this is we're recording this in January 2026. So I just want to ask you as well. Obviously, you mentioned Nestle. That's not something you're recommending necessarily right now for everybody, correct? It's just an example.
Just as a disclaimer.
Yeah.
No.
Okay. All right. Well, and in terms of looking at when the bull market's going to come to an end, I mean, would that typically be something where we see the US maybe running a budget surplus and not going deeper and deeper into debt? Would that be an indicator that might warrant rethinking?
That definitely would. But again, we're a long way from that right now.
Wonderful. All right, Adrian, well, look, you've seen many bull markets. You've seen many bear markets. Do you have any final words of wisdom here for our audience?
Yeah. First of all, I think people should understand that all investments, if you're not in a short-term treasury bill, all investments can be volatile to some extent or another. So you have to know yourself and you have to know how much volatility you are prepared to accept. That's the first thing I would say. And I think the second thing is, you know, always try to, it's always exciting when assets are going up, but always try to, you know, take money off the table in a bull market, put some money aside, whether it's to buy things that are more low risk. Maybe you sell some juniors and buy Franco. Maybe you sell some gold stocks and buy gold bullion. But put stuff into something that is more secure. But that's an important point, is to always try to sort of right size, not go overboard with any one particular investment.
Okay. Well, that's a nice word of caution to end on. Thank you for joining us here with Adrian Day of Adrian Day Asset Management.
Thank you. Thank you.